So yesterday we covered, we studied the balance sheet, the income statement, and the cash flow statements. Today we shall look at ratios. But before we look at ratios, let's just look at a very, very simplified overview of group accounts. When we talk about group accounts, we mean when companies acquire other companies. When you have a group of a parent company and a subsidiary, there are specific accounting treatments that you have to keep in mind. Now, again, this is not an accounting qualification, so you don't need to go into much depth. The only thing you need to keep in mind is what is considered to be a subsidiary and how do we account for subsidiaries in the balance sheet and income statement. We're not going to go into much depth, so let me just highlight the main areas that you might be questioned on in the exam. So first of all, what is a subsidiary? So assuming that company H is the parent company, H owns 100% of A. Obviously, A is a completely owned subsidiary of H. H owns 80% of B. B is still considered a subsidiary. Why? Because H owns over 50% of B. So any company that owns over 50% of another company, that other company is considered to be a subsidiary. So B is still considered to be a subsidiary of H because H owns more than 50% of B. Now, obviously, A owns 60% of C. So C is a subsidiary of A, who is in return a subsidiary of H. So when H is creating its financial statements or its financial reports, generally speaking, H as a company can create its own set of financial statements, its own sales, its own costs and expenses and assets and so forth. But it also creates a set of accounts as a group because H owns multiple companies. Now, H owns 80% of B. That means there is a minority interest of 20% in B. And A owns 60% of C. That means there is a 40% minority interest. Minority interest means other shareholders who do not have control. So they own a piece of the company, but they don't have control over it. So what's important to keep in mind is that when we are creating the balance sheet, we're talking about the group now. When we are creating the balance sheet or the statement of financial position, when we are creating the balance sheet for the group, we will take all of the assets of the group. So assets are at 100%. So even if we own only 80% of B, H as a group will take into consideration all of the assets of B. That means we are going to add all of the assets of B with all of the assets of A with all of the assets of C. Even though we don't own all of that company, but because we have control over B and C, international standards say, if you have control over a company, even if it's just 51%, you have to put in all of their assets on your balance sheet. And the same thing for the liabilities. We have to take into consideration 100% of all of these companies of A, B, and C on our balance sheet. Why? Because H has control over all of them. The only difference is when it comes to equity. Since H doesn't own all of the equity of B and C, remember, there is 20% equity to a minority interest of shareholders, and there is a 40% in C to minority interest. So when it comes to equity, H as a group lists under equity what it actually owns. So it will show 80% of B, and it will show the 60% of C. But it should also account for the 20% minority interest. So the accounts should show the 20% minority interest of B, and the accounts should show the 40% minority interest in C. So the only thing that you need to remember for the exam is on the balance sheet, as long as we own more than 51% of a company, we have control of that company. That company is a subsidiary. We will include all of the assets in our balance sheet, all of the liabilities, and we will only show the equity that we own. But we should also show whatever minority interest remaining in that subsidiary. That's for the balance sheet. When it comes to the income statement or the profit and loss statement, again, you account for all of the revenue in all of the companies that you have control over, and you account for all of the costs in all of the companies that you have control over. However, when it comes to the net income or the net profit or the profit after interest and tax, you need to split and basically account for the minority interest. So again, for the income statement, revenue and costs, you take 100% of them, but net profit, you have to show how much goes to the shareholders of each group and how much goes to the minority interest. So you don't split the revenues and the costs between the shareholders of the group and the minorities. You don't. What you do split is the net income. And of course, if you distribute in dividend, you show how much is going to the shareholders of the group and how much is going to the minority interest. Right. Let's look at the ratios. Just going to remind you what we need to cover in the ratios. Basically two things. The calculation of these ratios, although I doubt, because most of our students say the number of mathematical questions out of 100 is less than 10. So everything that we've covered in mathematics in chapter 2, in chapter 5, and in this chapter, out of 100, you're barely going to get maybe 5-6 questions of mathematics. So I believe that you're probably, of course, you're going to be asked about ratios. Ratios are a guaranteed question in the exam. I think you are more likely going to be questioned on how these are interpreted. So the first ratio, earnings per share from the name, this is how much profit is attributed to every share. Profit available to the ordinary shareholders, net profit, over the number of ordinary shares. So what is this profit available to the ordinary shareholders? It is your profit after tax minus the preference dividends. Remember, you have to pay your preference dividends first before you pay the ordinary shareholders, minus the minority interest. We said you have to consider minority interest. This gives you the profit available to the owners of the parent. Yes, CISI might ask you, which of the following is taken into consideration when calculating the profit for ordinary shareholders? You need to keep in mind that you remove, because this is a commitment, the preference shares, the preference dividends, and of course the minority interest, you have to take them into consideration because not everything is for you. Now, most companies can show you the earnings per share. For example, they would say the profit attributed to ordinary shareholders, let's say the total profit is $10 million. And let's say we've got 5 million shares outstanding. So the earnings of every share is $2. But companies are also required to show any potential diluted earnings per share. What is the diluted earnings per share? Remember when we talked about convertible bonds and warrants, and we said these are securities that might be converted into ordinary shares. That means the holder of these securities might choose on maturity or redemption, they might choose to convert the money into ordinary shares. That means the company might have to issue new shares as a commitment for these convertible bonds or warrants. In that case, if these shareholders decide to exercise, if these bondholders or warrant holders decide to exercise their right, then the company will have to issue new shares. So this $10 million will no longer be distributed among 5 million shares. They might be distributed among, let's say, 7 million shares. These extra 2 million shares were issued because warrants and convertible bonds were exercised. They were converted into ordinary shares. So this is the diluted earnings per share. So why is it important? Because I, as an ordinary shareholder, can see here that, okay, every share I own is entitled to $2 of profit. But in reality, if this company has issued warrants or convertible bonds, in reality, I might not be entitled to $2. I might be entitled to, let me just calculate, 10 million over 7. I might be entitled to actually $1.43 only, because this $10 million will need to be distributed among a bigger number of shares if these warrants and convertibles are exercised. So just keep in mind the difference between a normal earnings per share and a diluted earnings per share. PE ratio. From the name, it's price. Usually in this qualification, whenever you hear the word price, you can assume by default that this is the market price. So the market price of every share over the earnings per share. So let's say I am entitled to $2 of earnings for every share. Is this a good amount? Well, it depends. If I'm going to get $2 for every share, obviously I need to buy the share. How much am I going to pay for it? So let's say this share is going to cost me $50 to buy it, and it's going to get me $2 of profit. That means I'm going to pay 25 times for it. Let's assume another company, same company, is earning $2 per share. However, this company, if I'm going to buy the share, I will only pay $10 to get it. So I am only paying 5 times more for it. So this other company is considered to be cheaper. This company is considered to be more expensive because you are paying a lot to get this $2 of earnings. In the exam, PE ratio is one of the most popular questions, not just in this qualification, in most CISI qualification, because it's one of the most popular ratios used by investors. Usually the question is, what does the PE ratio tell you? The PE ratio tells me whether a company is expensive or not. 2, and that's the most likely answer in the exam, it tells me the high growth prospects. So why is this company so expensive to buy? Why am I going to pay 25 times to buy it? Because this company is undergoing growth and it's expected to see more growth in the future. So investors are willing to pour in more money to buy it, and that's why it's more expensive. A high PE shows you high growth prospects. Now, this is called the historic PE ratio. Why? Because this earnings per share is according to the last reported financial statements. So this was the $2 earnings per share from the last quarter or from the last annual report. In addition to the historic PE ratio, you can also have what we call the forecasted or the expected PE ratio, where you get to calculate the PE ratio in the future with some earnings assumptions. So a company with an earnings per share of 6.83, so the earnings per share is 6.83, and the shares per share price of 35, because we're talking about pence here, this is in the UK. What is the PE ratio? The PE ratio is 5.1 times. That means you are going to pay 5.1 times to buy this share. Another ratio is the enterprise value, the value of the company, over its earnings. But we don't take the net earnings. We take the earnings before interest, tax, depreciation, and amortization. So what we're trying to see here is how much are we paying if we are going to buy this company, how much are we paying compared to how much we are going to be earning? It's very similar to the PE ratio, but the PE ratio is looking per share, the price per share over the earnings per share. And the PE ratio usually uses the earnings per share, which is the net profit. However, the enterprise value, the value of the company, how much, if we're going to buy it, that's what we're going to pay, over how much is this company earning before paying interest, tax, depreciation, and amortization. Amortization is similar to depreciation. Depreciation is when you depreciate fixed asset, tangible asset, like property. Amortization is when you depreciate intangible asset. Again, if this is high, the higher, the more expensive the company is. The lower, the more value you are getting when you're invested in this company. So what is the enterprise value? What is the value of that company? It's the market value of the debt plus the market value of the equity of that company. And what is the EBITDA? It's your profit, but before interest, tax, depreciation, and amortization. Dividend yield, very similar to the coupon yield that we covered in chapter 2, which is basically how much are we earning on this bond over how much did we invest. Dividend yield is the same thing. Let's say a certain share is distributing dividend per share of, let's say, $2. And in order to buy that share, you are going to pay $50. That's the market price. That means for every $50 you pay, you're going to be earning a $2 dividend on it. So this should give you a 1% dividend yield. Now, besides calculating the dividend yield, what other things you should keep in mind? You should keep in mind what sort of companies give you low dividend yield and what sort of companies give you a high dividend yield. So basically, CISI might ask, small companies and large companies, which one pays you a low dividend yield? Which one pays you a high dividend yield? Well, it's not about size.
Sorry, the size here, we are talking about market cap?
No, here, well, it might be probably no size when it comes to assets or profit. Yeah, an SME and a big corporate. No, this is, CISI would just say a small company and a large company. It can be a market cap, it can be in size of the balance sheet or the profit and income statement, profit and loss statement. The point is, CISI might ask which of these two companies might give you a low dividend yield, which one give you a high dividend yield. Small companies give you a low dividend yield. Why? Not because they're small, but because any cash that they generate is going to be used for growth. The company will reinvest cash generated back into the company for growth. And investors who invest in small companies know that. Very rarely would you find an investor in a small company that would say, hey, give me dividend. He would say, no, don't give me dividend now. Whatever cash you've generated, whatever profit you've generated, put it back into the company. Expand. New warehouses, new offices. And because that cash is used for expansion, it's not distributed. So the dividend yield drops. There is barely any dividend. Large companies have usually reached maturity. That means they barely grow by 2-3% every year. They are very cash rich. They really don't know what to do with all that money. So they will just say, you know what, let's reward our investors. So large companies will distribute more dividend because they are cash rich and they've reached maturity and they have no use for that extra cash. So this is a quick example of the dividend yield. Now, just to, you might get a question on dividend yield in a different way. Here, the dividend yield is looking at dividend distributed for every share. So every share gets a dividend of $2. And the market price for every share. The market price is $50. Another way for you, of course, to calculate the dividend yield is to look at the dividend for all shares, or the total dividend, over the market value of all shares, or what we call the market capitalization of the company. So the question might say, the company is distributing $2 million among all shares, and the market capitalization, or the market value of all shares, is $50 million. This will still give you a 1% dividend yield. In the exam, CISI might give you total dividend for all shares, or they might give you the dividend per share. Remember, the value of all shares, to calculate the value of all shares, is the price per share times the number of shares. This is the market capitalization of the company, or the market value of the company. CISI sometimes calls it market cap or market value. Although the more conventional use in practice is market cap. So a company has 60, this is an example, 60 million ordinary shares, currently trading at 35 pence each. And an income statement as illustrated, the dividend yield would be, I think we can put that, a total dividend of $2 million. So we will use the market capitalization value. So the total dividend for all shares is 2 million. They're using the pound, over the market capitalization, or the market value, the market cap, or the market value, which is the number of shares multiplied by the price of every share. Let's just do that quickly. So 60 million times 0.35, 35 pence is 0.35 pounds. So that's going to give you 21 million pounds. 60 times 35 pence is 21 million. So let's just divide 2 by 21. So that's going to give us a 9.5% dividend yield. Right, let's just do this calculation one last time. So 60 times 0.35, yes, 21. So same answer, just rounding. But CISI here looked at the dividend per share and divided it on the price per share. Just another way to solve for the same answer. Dividend cover, easy concept. Cover usually says, do we have enough profit to cover this? The dividend cover is, do we have enough profit to distribute dividend? So if the company decided that they're going to distribute dividend of 3.33 pence for every share, and every share is earning 6.83 pence, then that means this company is able to cover, or the profits of the company are able to cover this distribution twice. So you as an investor can roughly say, okay, at this level of profitability, the company can pay us dividend for 2 years. Because profit earned per share is twice as much as the dividend distributed. So this year they can distribute 3.3. Next year they can also distribute 3.3. And the profit is still able to cover both distributions. So a dividend cover is basically dividing your earnings per share, your profit per share, over the dividend per share. And see, of course, the higher the better. The higher the dividend cover, the stronger the position of the company, and the more likely that the company is going to continue distributing dividend in the future. A worrying sign is usually when the dividend cover is going down. This is usually a negative sign for investors, saying that the company might not be able to continue distributing dividends in the near future. Gearing, sometimes called the leverage ratio. The official definition in the exam is a ratio that tells you the capital structure of the company. Remember what the capital of the company is? The capital of the company is both the debt and the equity. The higher the debt, the more leveraged or geared the company is compared to the equity, of course. Now, keep in mind that in this qualification, in debt, we also consider preference shares. Even though preference shares are technically shares, equity, but because they are a commitment on the company to distribute coupon, fixed coupon, and to redeem in many cases, they are considered accounting-wise, they are considered as debt. Also overdrafts. Of course, the lower the better. Debt ratio or the leverage of a company is one of the most important ratios used in value investing. Investors like Warren Buffett look at leverage and gearing. They don't like companies that have high debt compared to equity. The interest cover, same thing as the dividend cover. Do we have enough profit to cover the interest payment on the loans that we've taken? Do we have enough profit to pay the coupon on the bonds we've issued? Do we have enough profit to pay the interest on the loans that we have taken? Very similar concept. Do we have enough profit to pay interest on the debt that we have taken? Again, the higher, the better, because it tells you that this company is more likely to cover its interest expense. The higher, the better. The higher, the better. We call this the safety margin. The higher, the safer the company is. Because remember, interest expense is a commitment. Unlike dividend, a company can decide not to pay dividend. So really, we don't have to worry about safety when it comes to dividends. But when it comes to interest cover, we need to look at how much profit we have and how many times can it cover the interest expense. Liquidity ratios. Liquidity ratios here, we're not talking about the liquidity of the shares in the stock market. We're talking about the liquidity of the company. Does the company have enough cash to pay its short-term commitments? Do we have enough cash to pay salaries? Do we have enough cash to pay our suppliers? Do we have enough cash to pay the short-term interest debt? Do we have enough cash to pay whatever current liabilities that come up? That's the current ratio. So do we have enough current assets to pay for our current liabilities? What are our current assets? Our current assets are our cash plus our debtors, which we said are sometimes referred to as receivables, which are the invoices we've sent to our customers awaiting payment, plus our inventory, goods in the warehouse. Adding all of these together gives you the current asset. Do we have enough of that to pay for our current liabilities? Current liabilities are your payables, your trade payables, your accruals, and your commitments to other third parties. Of course, the higher, the better. The higher, the better. And it should be over 1. So the result should be higher than 1. If the result is less than 1, that means you have less current assets than current liabilities. That's a problem. That means you don't have enough liquidity to cover your short-term commitments. A very similar ratio to it is what we call the quick ratio, sometimes called the acid test. It basically says, do we have enough cash and receivables considering that the inventory is not sold? either because this is a company that doesn't have inventory, like let's say this is a services company, doesn't have any inventory, or assuming that it's a manufacturing company, but it wants to assume that the inventory doesn't get sold for some reason. Do we have cash and receivables only to pay for all of our corporate current liabilities? So it looks at the current assets without inventory. Again, the higher, the better. Next ratio is the return on the capital employed. Whenever you hear the word return, talking about profit. How much did we generate from operating profits? Again, sometimes referred to as profit before interest and tax, or earnings before interest and tax, sorry, over the capital employed. What is the capital employed? Well, the capital employed is your total equity plus your long-term liabilities, which is your equity plus debt. So how is the company using the shareholders' equity? How are they using the debt that they have raised? How are they using that capital to generate profit for the shareholders? The higher, the better. Now, another way for writing the capital employed is the total assets minus the current liabilities. Or it can be your equity plus your long-term liabilities. It's the same thing. Let me just write this down. So your total assets equal to your equity plus your liabilities, right? Your long-term or non-current liabilities plus your short-term liabilities or your current liabilities. This is the accounting equation, right? So if we bring this current liabilities and we bring it to this side, it will say total assets minus current liabilities will equal to equity plus long-term liabilities. Just keep that in mind. So you might see capital employed as this, or you might see it as this in the exam. Similar to it, you've got the return on equity ratio, which looks at your net profit, but divided only by your equity, not considering debt. So it only looks at your equity. These two ratios are considered profitability ratios. It tells you, it shows you how the management of the company is using either the equity of the company or the equity and debt of the company to generate profit for the shareholders. Profit margin. How much profit over how much sales? So this can either be your gross profit margin, which looks at your gross profit compared to your sales. So this is your gross profit margin. Or your net profit margin, which looks at your net profit over sales. That means how much profit are you generating from every $1 of sale? Again, the higher, the better. Why do we use ratio analysis? Well, simply, we want to assess the business performance. So just because we are making 1 million of sales and 200,000 of profit, that doesn't tell us much about the business. We need to compare the business to itself last year. We need to compare the business to itself in the last quarter. We need to compare the business to its peers in the market. And ratios help us with that. Ratios also summarize financial information. So if I say the return of equity has gone up, well, just by saying that, it's a positive thing. because I know that the profit of the company has improved compared to the equity invested. It also helps you identify the strength and the weaknesses in the company, either from the previous period, for example, the performance of this company now compared to last year or last quarter, or to its peers in the market, or to the market average or the sector average. So if a company's return on equity is 5%, but its peers are 7%, and the sector is 6.5, and the market is 6.3, then this company's return on equity, I mean, the investors shouldn't be very, very happy, because the market and the peers are doing better. So your money is probably better invested somewhere else. Of course, you're not going to make an investment decision just based on one ratio, but it highlights certain weaknesses. Limitations of the ratio analysis. Ratios use historic data, most of them. So this is just in the past. And of course, the past is not indicative of the future. Ratios are not predictive. Different accounting methods can be used, from difference between the US GAAP and UK GAAP and international accounting standards. So if the company prepares its financials according to the international standards, you might get a return on equity of 5%. But if it uses it according to the UK GAAP, you might get a return on equity of 4%. Just because the accounting and the financial reporting has differed. That's the problem. Significant judgment is needed when performing a ratio analysis. Some people would say a 5% return on equity is good. Some people would say, nope, it's not. Some people would say, I'm happy with the dividend yield of 3%. Others would say, nope, I need at least 6%. There's a lot of subjective opinion when it comes to ratio analysis. Some people would say, I would rather use operating profit. Some people would say, no, I would like to use the net profit.